To understand the magnitude of what just happened with Bitcoin, we need to go back several weeks and look at the price structure that had been forming. Bitcoin had been trading in a well-defined range, repeatedly testing a key resistance level that technical analysts across the industry had flagged as one of the most consequential price barriers on the chart. Every time price approached that zone, sellers stepped in with conviction, pushing Bitcoin back down into the range. It happened once, twice, three times, and each rejection built more skepticism among retail participants who began to wonder whether the rally was simply running out of steam. The mainstream financial media was quick to amplify that narrative, and fear began creeping back into sentiment indicators. The Crypto Fear and Greed Index had been oscillating in neutral territory, refusing to tip convincingly into greed, and funding rates across major derivatives exchanges were relatively balanced, suggesting traders were not over-leveraged on the long side. All of that, on the surface, seemed to point toward a market that was tired and directionless. Then Bitcoin broke out. The breakout came with something that every seasoned market participant knows matters enormously in technical analysis. It came with volume. Not just a slight uptick in trading activity, but a meaningful, undeniable surge in volume that accompanied price as it pushed decisively above that key resistance level. When a breakout happens on low volume, it is often dismissed as a fakeout, a manipulation attempt, or simply noise. But when volume confirms the move, when the market is actively participating and real capital is flowing into the asset at the moment of the break, that is a signal of an entirely different magnitude. That is what happened here. Bitcoin pushed through resistance with force, and the volume profile behind that move has given technical analysts and institutional strategists fresh reason to take the rally seriously. What happens next after a major resistance level breaks is critical to understand. And here is where the conversation gets particularly interesting from a structural standpoint. In technical analysis, resistance that is broken becomes support. The level that sellers defended so aggressively for weeks becomes the floor that buyers now stand on. If Bitcoin can consolidate above this newly converted support level, hold it through any short-term pullbacks or retest attempts, and then push higher from there, it would be a textbook confirmation of a bullish breakout. The early price action following the initial break is showing exactly that kind of behavior. There have been brief moments of consolidation, short periods where sellers have tried to push price back down toward the breakout zone, and each time buyers have stepped in and defended it. This is the kind of price behavior that builds the foundation for sustained upside moves. Now let us turn to Ethereum, because the moves happening in ETH right now are arguably just as important as what Bitcoin is doing, and in some ways, they may be even more significant for the broader market ecosystem. Ethereum has surged with notable momentum in correlation with Bitcoin's breakout. But what stands out in the ETH chart is that it has been showing signs of independent strength for several days leading up to this broader market rally. The ETH to BTC ratio, which measures Ethereum's performance relative to Bitcoin, had been quietly recovering from deeply depressed levels where it had spent an uncomfortably long period of time. When that ratio begins to turn upward with conviction, it historically signals the early stages of altcoin season, a phase in the market cycle where capital that has been concentrated in Bitcoin begins to rotate more aggressively into alternative assets, compressing risk premiums and lifting the broader market. The fundamental case for Ethereum also continues to grow stronger with every passing week. The development activity on the Ethereum network remains among the highest of any blockchain in existence. The ecosystem of decentralized applications, decentralized finance protocols, non-fungible token platforms, and Layer 2 scaling solutions built on top of Ethereum continues to expand at a remarkable pace. Gas fee revenue on the network has been increasing, a signal that actual utilization and economic activity on the blockchain is growing, not declining. When you combine robust on-chain fundamentals with the kind of price momentum Ethereum is now displaying, it creates a compelling case that this is not simply a speculative pump driven by sentiment alone. There is real, measurable activity underneath this move, and that is the distinction between a sustainable rally and an empty price spike that collapses as quickly as it appeared. Beyond Bitcoin and Ethereum, the broader altcoin market deserves serious attention right now, when the two largest assets by market capitalization are moving upward with strength and conviction. The psychological effect on the entire market is powerful. Risk appetite increases. investors who had been sitting on stablecoins or waiting for confirmation begin deploying capital. Projects that had been dormant or trading sideways for extended periods suddenly attract attention, volume, and price appreciation. We are already seeing this dynamic begin to unfold across multiple sectors of the crypto market. Layer 1 blockchain competitors to Ethereum are posting significant percentage gains. Decentralized finance tokens are rallying. Infrastructure projects and interoperability protocols are seeing renewed interest. The market breadth, meaning the percentage of assets that are participating in the upward move rather than just a small handful of large cap names, is widening, and that is one of the healthiest signs a bull market can show. It is also worth examining what is happening in the derivatives market, because the activity in futures and options provides a window into how institutional and sophisticated traders are positioning themselves. Open interest in Bitcoin futures has been rising alongside the price breakout, which means new money is entering the market and taking positions, rather than the rally being driven purely by short squeezes that will naturally exhaust themselves. Funding rates in perpetual futures contracts, which had been relatively neutral in the weeks prior to the breakout, have moved into positive territory, indicating that long side bias is increasing. This is worth monitoring closely, because if funding rates become excessively elevated, it creates the conditions for a long liquidation cascade where over-leveraged longs are flushed out in a sharp but temporary pullback. For now, the levels are elevated but not yet in the danger zone that would signal a significant correction is imminent from a derivatives perspective alone. The options market is also delivering a clear message. The options skew, which compares the demand for call options versus put options, has shifted decisively in favor of calls, meaning traders are paying a premium to position for further upside rather than downside protection. This is a significant change in market positioning. For a considerable period, the skew had been relatively neutral or mildly negative, reflecting uncertainty and a desire among market participants to hedge against another leg down. The shift we are now seeing in the options market suggests that institutional participants are not just watching this breakout from the sidelines. They are actively positioning for it to continue, and they are doing so through instruments that require real capital commitment and financial conviction. On-chain data adds another layer to this analysis that is impossible to ignore. Bitcoin exchange outflows, meaning the movement of Bitcoin from centralized exchanges onto private wallets and cold storage, have been elevated in recent days. This is one of the most bullish on-chain signals available to analysts. When investors move their Bitcoin off exchanges, they are removing it from the available supply that can be sold at any moment. They are effectively putting it into long-term storage, signaling that they do not intend to sell in the near term, and that they expect prices to be significantly higher in the future. Sustained exchange outflows, in conjunction with a price breakout, is a combination that historically has preceded extended bull runs, not temporary spikes followed by sharp reversals. The long-term holder data is also constructive. The percentage of Bitcoin supply that has not moved in more than 1 year continues to sit near historically high levels, meaning that diamond hand investors who have been accumulating through previous bear markets are not distributing their holdings into this rally. We also need to address the macroeconomic context, because crypto does not exist in a vacuum, and understanding the broader financial environment is essential to assessing the sustainability of any crypto market rally. The global macro landscape has been shifting in ways that are increasingly favorable for risk assets, and Bitcoin in particular. Inflation data in several major economies has been cooling gradually, which has brought renewed speculation about central bank policy pivots. When central banks move toward looser monetary policy, cutting interest rates and increasing liquidity in the financial system, it historically provides a tailwind for assets that are perceived as stores of value or high growth opportunities. Bitcoin, with its fixed supply cap of 21 million coins and its predictable issuance schedule, fits both of those descriptions simultaneously. Institutional investors who have been cautious about crypto during periods of tight monetary policy and rising interest rates are now reassessing their allocations. And the inflows we are seeing across regulated Bitcoin investment products suggest that this reassessment is translating into real capital deployment. The regulatory environment, which has been a persistent source of uncertainty and headwind for the crypto industry over the past several years, is also showing signs of gradual maturation. While the global regulatory picture remains complex and uneven, with different jurisdictions taking vastly different approaches to digital asset oversight, the overall trend toward clearer frameworks and defined rules is a net positive for the industry. Regulatory clarity, even when it involves new compliance requirements, is preferable to the ambiguity and enforcement by action approach that characterized much of the recent past. When investors, both retail and institutional, can make decisions with a clearer understanding of the legal and regulatory landscape, it reduces the perceived risk premium attached to crypto investments and opens the door to broader participation from segments of the market that had previously been sitting out due to compliance concerns. The narrative around Bitcoin as a legitimate institutional asset class is also evolving in real time. The availability of regulated investment vehicles that provide exposure to Bitcoin has made it accessible to pension funds, endowments, family offices, and wealth management platforms in ways that simply did not exist during previous market cycles. These are pools of capital that move slowly, require significant due diligence before deploying, and tend to hold their positions over long time horizons. When this class of capital begins flowing into an asset, it creates a different kind of price dynamic than the retail-driven frenzies of previous cycles. It is more measured on the way in, but it also tends to be more resilient on the way down, because institutional investors with long time horizons are far less likely to panic sell during temporary drawdowns than retail participants who leveraged up at the top of a speculative bubble. It would be irresponsible, however, to present only the bullish case without acknowledging the risks that remain present in this market. No analysis is complete without an honest assessment of what could go wrong, and there are several factors that investors need to keep in their awareness, even as the current momentum is clearly upward. First and foremost is the risk of a sudden macro shock. Financial markets globally remain sensitive to unexpected data releases, geopolitical developments, or policy announcements that can shift risk appetite dramatically and quickly. Bitcoin and the broader crypto market, despite the maturation of the asset class, still retain a meaningful correlation to global risk sentiment during periods of acute stress. A significant deterioration in the macro environment could temporarily override the positive technical and on-chain signals we are currently observing. Second, the risk of over-leveraging in the derivatives market growing from manageable levels to dangerous ones is something that needs to be monitored daily, not weekly. Markets move faster than analysis cycles, and the buildup of excessive leverage can turn a healthy pullback into a violent liquidation cascade within hours. Third, regulatory risk, while diminishing on a structural level, never fully disappears. A major enforcement action, a significant policy announcement from a systemically important jurisdiction, or an unexpected development in ongoing legal proceedings involving key industry participants could introduce volatility that shakes out weaker hands. Understanding these risks is not bearish. It is responsible. Every professional investor manages risk as seriously as they pursue opportunity, and the investors who have built lasting wealth in this space are not the ones who went all in on every pump and held through every dump. They are the ones who understood the market deeply enough to distinguish between noise and signal, to size their positions appropriately, to have a plan before they entered a trade, and to stick to that plan with discipline even when emotions were pulling them in a different direction. That is the standard of thinking that separates consistent performers from the statistics of retail investors who, study after study shows, buy at the top and sell at the bottom. The market is designed to take money from the underprepared and give it to the disciplined, and that fact does not change regardless of what direction the market is moving in. Looking forward, the technical targets that analysts are now discussing in the context of this Bitcoin breakout are significant. Once a key resistance level has been cleanly broken and converted to support, the next areas of interest on the chart become the subsequent resistance zones above the breakout level. These are the prices where selling pressure has historically emerged and where the market will need to prove itself again. Each successive resistance level that is broken and converted to support in a bull trend builds the broader structure of a sustained upward move. For traders, these levels represent natural areas to take partial profits, to reassess positioning, or to add to positions on successful retests. For long-term investors, they represent milestones in a journey toward price discovery at new all-time highs. and the case being built by the technical, on-chain, and macro data increasingly suggests that such a journey may already be underway. The market is not giving any guarantees, it never does, but the weight of evidence right now is pointing in a direction that serious investors should not dismiss or minimize. For Ethereum specifically, the potential trajectories being mapped out by analysts are equally compelling. Ethereum's price has historically lagged Bitcoin's initial breakout before accelerating in percentage terms once the broader market rally gains momentum. If the pattern from previous market cycles holds, Ethereum's recent surge may be only the beginning of a much more significant move. The combination of Ethereum's strong fundamental backdrop, its dominance in smart contract infrastructure, its growing Layer 2 ecosystem, the continued development of its roadmap, and its deflationary supply mechanics post-merge, with the kind of technical price action we are now seeing, makes a credible case that ETH could deliver outsized returns relative to Bitcoin in the months ahead. That is not a prediction. That is an assessment of probabilities based on available data, and every investor should weigh it accordingly based on their own risk tolerance, investment horizon, and portfolio objectives. Outro. That brings us to the close of today's coverage here on Crypto Hub. What we have walked through today is a market moment that deserves to be taken seriously, analyzed carefully, and acted on thoughtfully. Bitcoin breaking a key resistance level with volume confirmation, Ethereum surging with independent strength, altcoins beginning to participate, on-chain data reflecting accumulation rather than distribution, derivatives positioning showing genuine conviction rather than reckless leverage, and a macro backdrop that is gradually becoming more accommodating for digital assets. All of these elements are pointing in the same direction at the same time, and that alignment is rare enough to command attention. We will continue to monitor every development, every data point, and every shift in this market and bring you professional, fact-based analysis the moment it matters. If this breakdown gave you value today, take a moment to support the channel by subscribing and sharing this content with others in your network who follow the crypto space seriously. The conversation is just getting started, and here at Crypto Hub, we will be with you every step of the way. Stay informed, stay disciplined, and we will see you in the next one.